What is going on? Happy Thursday, everyone. Welcome, 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 welcome into the room. I'm so excited because this live today, number one, it's been a long time coming, but number two, this is the first live in our brand new monthly LinkedIn live series where every single month we're going to be talking about a tax strategy, tax opportunity specifically designed for high income earners. And so I'm so excited to be with you today. And so let's not delay, let's jump right into the content for today. So every single year, high income earners leave at least $30,000 to $70,000 in tax savings on the table. That's not because they're not smart. It's not because they don't care, but it's because they don't have a plan. And let me tell you, this becomes painfully obvious as we head towards the end of the year. So my name is Lauren Ballard. I'm a CPA with over 15 years in the tax business. And here's what I see happening right now. It's December. You're realizing your tax bill is going to be bigger than you anticipated, and you don't have a clear plan to address it. So you're thinking, should I buy a piece of equipment, maybe max out an IRA, make some random move and hope it helps? And there's this feeling of kind of like, you know what? I've waited too long. Let me throw up a Hail Mary pass and see what happens. But here's the thing. You've not waited too long. You're just looking in the wrong places. And so in today's live, we're going to discuss 5 specific opportunities. For the sake of this presentation, I'm calling them 5 leaks where high earners leave money on the table. And let me be clear, this is not random purchases. This is not generic advice. This is targeted strategies with a real dollar impact. And listen, 26 days is enough time to plug these leaks, but you've got to know where they are. And so by the end of the session, you'll know exactly which ones apply to you and what to do to implement them and plug these leaks before December 31st. I want to just give a quick note here that for business owners, the first 4 leaks apply to everyone, whether you're W-2 or you have your own business. But if you stick around to the end, I'm sharing year-end strategies. I call it the year-end strategy stack. I'm super proud of this. This is something that HTA, Hilltown Advisors, has compiled specifically for entrepreneurs. And so you do not want to miss that. I want to make sure that you grab that. So please stay here, stay locked in. So if you are ready to go ahead and drop an emoji in the comments just so I know that you can hear me, that you are engaged. I'm glad you all are here. So let's jump into the content. So who is this for? And if you can hear me, drop a 1 in the comments. I'm so glad you are here. So this content is for entrepreneurs, W-2 employees, investors, anyone who is earning $400,000 or more per year. But before we could jump into the content, I do want to drop a quick poll and ask, yes or no, do you have a tax strategy in place? Yes or no? I'm going to pull up LinkedIn on my phone just to make sure that I'm seeing your comments in real time. Do you have a tax plan? You can drop it in the comments below, yes or no. All right, cool. We are connected on the phone side as well. So if you do not have a strategy, not to worry. This is your opportunity to get some things that you can implement seriously by the end of the year. So the first leak that we want to talk about, and I'm really excited about this one, especially when we think about what has happened with the OBBB, so OB3, the One Big Beautiful Bill Act. It is the charitable deduction miss. It is the charitable deduction miss. And so this is the issue, right? What is happening is that you are giving at least $2,000 annually to charity, but you are taking the standard deduction. Why? Because the SALT limitation has now dropped and you're not able to take advantage of that. And so this is how you can take advantage, right? So you are able to bunch 2 to 3 years of giving in 2025 using something called a donor advised fund. If for some reason it becomes too complicated, you don't have time to execute it based on your brokerage, based on trying to find who's the right provider for that program, you can still make charitable contributions if you have already earmarked and specified an organization that you want to donate to this year. And let me explain to you why this is so important. So what happened with the passing of the OB3, or the One Big Beautiful Bill, in July of this year is that the threshold for charitable giving got a haircut. So normally, if you donated, you were able to take up to 60% of your AGI as a write-off from charitable contributions. Well, the OB3 has now changed that. So what does that mean? That means for starting in 2026, there's first a floor that's put in place. So at half percentage of your AGI, for simplicity's sake, we'll say of your taxable income. So 0.5% of your taxable income will not be deductible. That is the floor. You can't take a deduction. Anything above that, you are able to take it. It is limited, but if you are in the top earning bracket, so if you make $600,000, $700,000, $800,000 a year, you are not going to get the full benefit of those deductions. So if you donate, let me give you an example of how this could look. So instead of donating $20,000 annually year over year, you could donate $60,000 or $80,000 in 1 year via a donor advised fund. And just by doing that, let's say you make $1 million, right? So if you made $1 million, automatically you are not able to take about $1,000, $2,000 of that deduction. Doing the math in my head, so forgive me if I'm off with that a little bit, but automatically you get a haircut on that deduction. Then anything in excess, if you are in the 37% tax bracket and you would be making $1 million, automatically you're now losing another 2% on your deduction. So this is why this is so important. So even if you haven't considered a donor advised fund prior to, with the law change, this is a great opportunity. So that's just a little bit about charitable bunching. So who is this good for? This is good for those who have traditionally taken the standard deduction because they were limited because of the SALT limitation, or because of mortgage interest limitations. It was more advantageous for you to take the standard deduction. This is for those people who are comfortable bunching 2 to 3 years of giving, and you have cash or appreciated stock available for contribution. I want to just mention the deadline for this. This contributions must be made by December 31st if you are giving directly to an organization, and a donor advised fund must be set up and funded by December 31st for you to be able to take advantage of this strategy. If you're tracking so far, go ahead and put a comment in the chat so that I can make sure that you are following. And we are going to move on to our next leak, because we've just covered what happens with charitable bunching. We've just covered what charitable bunching can do for you from a tax perspective. But this next leak that we're going to touch on is how investors losses, even, excuse me, tongue is getting tied here. The next leak is how investors can take advantage of losses even when they are winning in the market. I love this strategy. And if you are someone who is managing your own investments, this is important for you to understand. So if you have investments that are currently sitting at a loss, a lot of times as an investor, you're trying to figure out, okay, how can I change this position? How can I assess my positions to actually give me a return? What can I do in terms of my investment strategy? Maybe I need to look at a different fund. Maybe I need to look at a different security. But this is the piece that you're missing. What you can actually do is sell those losses, sell off those positions that have not actually been beneficial, that have not generated gains, but are currently sitting as unrealized losses, and use them to offset your realized gains in your portfolio. This is called harvesting losses, or tax loss harvesting. And this by itself can help you save 5 to 20K in tax savings in a year. Note the deadline to execute this strategy is December 30th of 2025. So let me give you an example of how this works. Let's say that you make $70,000 in income, and in your portfolio, you have now generated $200,000 in long-term gains. That's going to be taxed at the highest rate, which is going to give you a $40,000 capital gains tax. Now, in that same portfolio, you have $80,000 in unrealized losses sitting in your portfolio. This is what you're able to do. You are able to sell off those positions. And at the end of the year, what happens is that those losses are now going to offset the $200,000 in long-term gains that you recognized and realized in 2025. Your new tax is now $24,000 as opposed to $40,000, and that is a $16,000 savings when it comes to capital gains tax. Now, the one thing that I do want to make sure that you are clear on is that there is something called a wash sale. So you cannot sell a position and then immediately repurchase a significantly or substantially identical security within 30 days prior or after the sale of those securities or those stocks. That if that happens, those losses are going to be disallowed and add to the basis, which essentially means that you have to take advantage of them at a later date. You're not going to be able to take advantage of it for 2025. So you do want to make sure that you are keeping an eye on this. Now, if you have a wealth manager, financial advisor who is currently managing your securities, they should already be looking at opportunities to generate losses for you towards the end of the year. But if you are someone who self-manages, you've got to make sure that you are looking at this. So I want to note the deadline on this. So most of their strategies are December 31st. We have one strategy that is actually January 15th, but this one actually needs to be executed by December 30th because of it needs to be trade plus one for settlement date. So it has to be settled by December 31st. So the last day to initiate a trade would be December 30th. So far we've covered charitable munching. We just talked about how you can use underperforming stocks and securities to manage capital gains. Now, closing this next leak can save you 2 to 3% if you traditionally make estimated payments. Okay, make sure my slides are moving with me. Making sure my slides are moving with you. Okay, so this leak number 3 is the estimated tax trap. And this is the thing about the estimated tax trap. So if you are someone who traditionally makes estimated payments because you, in addition to your W-2, perhaps you have a business or your spouse has a business, etc., there what tends to happen is that if you have a big income spike throughout the year and you've made no quarterly estimated payments, what tends to happen is that you get to the end of the year and now you're looking and you're like, well, we have a tax bill and I guess we're just going to take whatever slap on the wrist, whatever penalties and interests are applied to us by the IRS. But this is the thing, there's actually a fix for this. If you pay 110% of your prior year's tax bill by January 15th, you are able to take advantage of something called the safe harbor rule. So what does that mean? The safe harbor rule is essentially, and so when we say 110%, so let's say in 2024, your tax bill was $100,000. So if by 2026, January 15th of 2026, you pay $110,000, you will not be required to pay any penalties for even if you owe as much as $200,000, $300,000. The remaining 90K will be due in April and there will be no penalties. And so this is significant, guys, because I have seen penalties upwards of $3,000, $5,000, $10,000 depending on the tax bill. And we're talking about a penalty for late filing, if you have extended and that's when you finally pay, and then an underpayment penalty. So we've got to make sure that we are getting a handle on this. This is the other piece too. If you have W-2 withholding, so if you're an entrepreneur, but your business is set up as a C Corp or an S Corp, an S Corp, and so you are receiving a K-1 in addition to your W-2, what you can also do is the last payroll period of the year, you can run an additional tax payment, and any W-2 withholdings are considered evenly distributed throughout the year. And so that's another great opportunity for you to be able to take advantage of minimizing and ultimately avoiding those underpayment penalties, again, which can be pretty significant. So we want to make sure that we are mindful of that. Now, we've got a couple more. I'm excited because we're almost through our content. We've got 2 more leaks that we want to address. But before we move on to the next one, I just want to be clear who this is for. Again, those entrepreneurs, spouses of entrepreneurs who filed jointly, who had big income spikes in 2025, business owners who perhaps have variable income, so you don't earn consistently throughout the year. Maybe you sold a property, a business, or had another one-time event. Or perhaps you did not adjust your withholdings appropriately throughout the year. This strategy, how to avoid these estimated tax penalties, this is for you. So now that you understand how you can avoid the underpayment penalties, the next leak happens to a lot of high earners. And most of you think you already have it handled. Let's move these slides right along. So the next leak is the tax advantage account gap. So if you are a W-2 employee and you have invested in your company's 401k and you've maxed it out, you got the match, it is very easy to say, hey, listen, I mean, I've done the best that I could. There's no real opportunity here for me to find any alternatives. There are some additional things that you can do to help increase how much you can defer. Now, I will say that there is a lot of complexity to this. And so I don't want to get into the weeds because this is nuanced. And so you definitely need to make sure that you're working with your CPA or financial advisor to assess whether or not this is the best decision for you and your family. But there's a couple things that we can do. We can do an HSA. Making a contribution to an HSA, you're able to take up to 80 $8,300 as a family or $4,150 as an individual. Tax deduction for this year, it grows tax-free. You can withdraw tax-free for medical expenses. You can invest those proceeds, those contributions like a retirement account. The deadline for that is December 31st. You can do a backdoor Roth contribution. This one in particular, you need the backdoor Roth and the mega Roth, you definitely need to make sure that it makes financial sense, especially considering your retirement plan, because sometimes you get to the same spot. So you got to make sure that you're clear on that and that it actually works for you. We'll go to the spousal IRA. This is great for people who are self-employed. You can create an IRA for them, and you can contribute $7,000 to that IRA for them, even if they're not working. The deadline for that is actually April 15th. So there's a bit of time for that one. The backdoor Roth contribution, we touched on that previously, just want to go back. It's April 15th for contribution, and you can do the conversion at any time. There will be a tax impact when you do that conversion. But again, it depends on your financial situation, if it makes sense for you to do that this year or not. And then we got the mega backdoor Roth, and you would need to connect with your employer to make sure that you can do that. So just breezing over that because there's a lot of nuance to that. But if you have any questions, please put them in the comments so I can address those after today's session and make sure you get clarity on that. So to this point, we've discussed opportunities that apply to everyone. We talked about charitable bunching and the donor advised fund. We've talked about tax loss harvesting and the timeline for that, and how you can turn unrealized losses into a tax benefit against your portfolio. We talked about how you can avoid the estimated tax trap and how you can avoid the penalties associated with that. We just talked about the tax advantage account gaps and looking how you can use HSAs, Roths, spousal IRAs as opportunities to save on your taxes. Now, this last leak is one that can easily add $20,000+ in tax savings annually, specifically for my entrepreneurs, my business owners. But even if you start now, you could potentially save 2 to 5%, right? And so excited to share this one with you. Let's go to the next slide. And so this is something that we have created specifically for our clients. So let me tell you the story about, sorry about that. Let me tell you the story about how we got to this point. So I had a client come to me who said, hey, listen, my wife and I are thinking about getting involved in either real estate or purchasing a business. We're going to start the process of doing due diligence this year, but we want to find a way to capture those losses and expenses prior to acquiring the business. So this is what we came up with to meet their specific needs. And I call this the business owner tax stack or the year-end strategy stack. And the reason why this is so powerful is because the amount of capital that's required to get this up and running is less than $1,000, but it can have a 5, 10, 15x multiple in terms of impact for you financially. So this is what happens. You combined a family management company and layer on specific tax strategies under that entity to be able to take advantage of that. So we start with the family management company. We then layer under that the Augusta rule, which allows you to rent your primary residence to your business tax-free if you rent it under 14 days, but it still is a deduction for your business. You then layer on family employment. So if you have children, especially children under the age of 18, you are able to pay them without the responsibility of payroll taxes. There is some entity structuring that's required for this, but that is the second strategy that we layered on. And then the last thing is layering on strategic expenses. And so when I say strategic expenses, I mean, if we're having a board meeting, if we have any travel that we're going to do because we're doing due diligence on properties that we're looking at purchasing, we're doing due diligence looking at a business that we're thinking about acquiring, that mix of strategies falling under that family management company is able to accelerate what you can deduct in the year. Now, this is the other piece. So normally when you are going through the process of doing due diligence, you have to, any costs related to the startup of the business, they have to be deducted once the business is started. However, based on my research from the code, you are able to actually accelerate those and take those expenses through the management company as opposed to putting them on and saving them until the business is started, as long as you have proper documentation in place regarding relationship between the family management company and the operating company. So I would say if you're looking to start a business in 2026, you're looking to start your rental business, you're looking to acquire a business, you can start that family management company today, begin to go through the process of due diligence today, and then already have the other entity set up, have agreements in place between the two. So it is clear that no, we are working on behalf of the other entity. And then you should be able to deduct those expenses. So I want to keep this tight. We have been at this for about 27 minutes. So I just want to move to the last slide. I know that we covered a lot, but I want to let you know that the information that I just shared with you is enough for you to make a significant move in the right direction for year end. I've revealed to you 5 leaks, talk through how you can close them and the potential benefits associated with them. But I want to just level set and say, I'm sure some of you watching this live, some of you watching the replay are thinking, okay, I can probably tackle 1 or 2 of these. But if you see that you have 3, 4, or even 5, and you're starting to think about the coordination, the timing, and making sure nothing triggers an unintentional consequence, I want to let you know that's where most people get stuck. Not because they're not smart enough to figure it out, but because we have a very tight timeline. There is 26 days until the end of the year. And you've got to manage that while closing out Q4 at work or in your business, managing the holidays and trying to coordinate between your brokerage, your 401k advisor, 401k administrator, and maybe setting up entities. It's a lot. So here's what I want to just say it out plainly. If you need help, please go ask someone. It doesn't have to be me. It can be your current CPA, it can be your current advisor, but please make sure that you are getting some support. If you do not have somebody that you're currently working with, by all means, please feel free to reach out to me. You can send me a DM and I will be glad to answer your questions. The other thing that I want to let you know that everything, I'm going to be sharing this replay, but I also have a giveaway for you now. So this year-end guide, I'm linking the year-end guide for you in the comments. So let me go to LinkedIn now and post that here. and action guide. If you have any questions, again, please feel free to reach out to me. I want to thank you so much for joining. And as I said at the beginning of this live, that if you have any questions, please do not hesitate to reach out. You can send me a message, send me an email, and I'd be glad to assist you. I want to wish you a wonderful rest of day, and have an amazing rest of year. And I will see you next month for our next LinkedIn Live. Until next time, have a good one.